Clay Patton on the Rural Radio Network, and it is time once again to catch up with Darrell Holaday, Country Futures, Frankfort, Kansas, to recap the week's trade and what we may expect next week. Now, Darrell, as we come into Friday's close here on the grain side of the complex, soybeans early on, concerned about Brazilian dryness. They're the leader to the top side. Here at the close on Friday, though, it's corn and wheat outpacing soybeans despite some new demand news. What do you make of the trade?
Yeah, it's interesting. We had two different dynamics going on at the different times of the week in the grain side. Early in the week, we were under pressure, went to a new low in December corn. We had talked a lot about this, that you thought December corn would go down and take out the lows in the September contract, which we did. As we approached first notice day, we saw December corn go to 447. Which was lower than Sep corn ever got to, and big carry told you it was going to do that, and the carry went clear out to 26 cents D-Smart, record carry for late November. So it did come back to the line with 21 cents, and it got so wide that it actually discouraged deliveries the first day. We did see over 200 contracts, but in reality, that's what happens. Markets moving out wide big enough to try to stop deliveries. And it did to some extent, but that's a real negative factor to occur. And the same thing happened on wheat to some extent, a little bit different in that we saw not quite the thought of big pressure of deliveries on wheat. We did see big deliveries in the softwood winter contract and pretty solid big numbers on the hardwood winter, over a couple hundred contracts this week. But as a whole, as we were going through that process, soybeans were rallying somewhat because of the fact that the concern about dryness in Brazil and central Brazil and northern Brazil. But all along all week, the one little nugget down there that was giving us trouble is the soybean meal market we saw go over 470 just 2.5 weeks ago on that December contract, which is continuing to fade. The spot meal market under pressure, especially the eastern meal markets came under pressure. The margins got too high, got high enough, and it shut off some of the demand. We're starting to see Argentina price some meal into the world market. Things changing there a little bit. And by the week's end, as you said, we'd kind of reversed places where the beans were back down, actually lower on the week, and we actually closed the wheat, corn, and wheat a little bit higher on the week after we got through the deliveries and found things on the backside. Across the board, there were better exports. The weekly export sales report was as best we've had all year for corn and really wheat, 670,000 for wheat, over 1.9 million for corn, good number for soybeans at 1.8. So it's shown that when you get down to where you're in the market, you're competitive in the world market, U.S. We'll move product, and we can, and we have, and we did to some extent, and we see those numbers. It's just that then we get rallies and we go blank for a while. But we did also see news this week was around where they focused on the OPEC. There was a lot of news about what OPEC Plus would do on the cut. They ended up cutting production really 620,000 barrels per day. That mainly came in the African nations, countries, I should say. Where Saudi Arabia really didn't cut theirs, but they've been the one that already cut. Keep in mind, this is a cartel that a lot of cheaters involved, and we never know what really comes out of there. But I never see cuts as real bullish. The market can see that. I think the market showed you that it didn't think that because it rallied up to 78.9 anticipating for it, and the crude oil ended up back down at the $74 level because of the fact that if they're cutting, it's the demand outlook cannot be good if they're cutting that production, and that's a factor, and I think one has to see that. And we saw also third quarter GDP came out. It was increased to 5.2% for the U.S. versus 4.6%, the first estimate. And that really was a good number, but the concern has to be now, and we saw it in this report, a big gap between GDP, which was at 5.2%, or just the raw number, the gap between GDP and GDI, which is gross domestic income, a real concern. It's the largest gap since 2008, and I think we all know what happened in 2008 and 2009. This is the explanation of why the consumer is being squeezed. You might be able to show some growth in the economy, but at some point it won't happen if there's this big gap in incomes, and that showed up very dramatically in this report. Obviously, the stock market didn't react, but the reality is could be a commodity issue. That may be explaining the squeeze that we're seeing on the consumers and also the overall demand, both on the grain side of things and also on the meat side that we will certainly had this week. On the week, December corn up 1 at 464 after hitting the low, as I said, of 447. D's 24 corn 514, 3 higher. January soybeans 13 a quarter, down 6. November 24 beans, we're up 2 at 12.82. December Kansas City wheat 6.45, up 3 after hitting the low down or closing last week at 6.02. July 24 wheat 6.56, up 31. January crude oil 74.07, down 122 on the week, but it at one time traded during the anticipation of the OPEC number got as high as 79 and then turned around and ended up 5 off of that high. On the livestock side, the cattle weaker again this week after we had a real sharp sell-off on Monday, followed by some strength at midweek, but also then another sell-off on Friday. Cash ended up being weaker, but they're just following the futures lower. This is just the Packers' ability to. They're not going to bid them up when the futures are under this much pressure. It's just simply cash has now moved in that mode of being a follower of the futures, and it's a good basis. But once again, I think this demand side is a real concern. A lot of concern about the LRPs that are purchased, and the insurance companies that have to cover some of that risk and how they have to do it. I think they've had some panic selling in this whole move down, no question about that. And it has an impact on the futures market. They can't just run in and sell futures. It's not really very easy to cover that risk. A lot of people don't understand. You just can't say they lay them off because that's not what they're doing. That's not what they're providing. But they do have risk to the downside, and they're trying to. I think they've tried to in the past. I think they've let it go and not worried about it. Now they've created some panic in the market by trying to find positions. I find it interesting. This was all created to get away to provide a substitute for the mercantile exchange, the put options and the futures. And guess where they run to when they get fearful of risk? They run to the Merc contracts. All the meat markets are nervous. It's a nervous market, and I think the concern about the demand that we talked about within the marketplace, within the industries, is certainly there, as we haven't been able to see the pork product, beef product quite perform like we want them to, although they haven't been that bad. It just may be a little below expectations, and I think that's put maybe the packer back in the driver's seat to some extent, both in the hog futures or the hogs with this big seasonal increase that we see every time this year. We'll see that seasonal peak in numbers this week or next week in the hogs, and also the same way with the cattle. We don't have some big numbers, but it's certainly we don't have the demand follow through. We have this products, all the poultry and the pork running around right now at cheaper price levels, but that will all change. But the real big picture concern would be as I mentioned earlier, that gap between growth in the economy and consumer income. On the day or on the week, December cattle 169.27 down 97 on the week. February cattle 169.12 down 185. Most of the cash was anywhere from 174 to 176 on a live basis, to some 274 to 276, maybe 273 to 276 in the meat basis across the plains area. January feeders 214.42 down 490. March feeders 217.22 down 550. December hogs 68.60 up 102, and the February hogs 70 and a dime up 133.
And that again is Darrell Holaday with Country Futures in Frankfort, Kansas. Give him a call, 1-800-292-4038. That's 1-800-292-4038. Do remember, trading futures and options involve risk of loss, may not be suitable for all investors. Do consider these risks before investing.